hate to break it to you, but you've been trading blind. A bold statement, because you must be thinking, I trade market structure, I trade SMC and ICT, I use the Fibonacci's and the trend lines. How can I be trading blind? Well, if you look deeper and you start to understand how roadmaps in the market go, when price goes from A to B, yes, it has a market structure involved. Yes, there's trend lines and support and resistance. Yes, you can justify it in all kinds of ways, but the reality is there is ways to explain the market, and then there's ways that the market actually moves. When price goes from A to B, it could go in a straight line, it could go up, down, up, or it could do multiple roadmap variations. When you go a level further, you start to realize time and sessions and inducements all build frameworks for what we call daily cycle variations. And in fact, in the last video, what I showed is that all the daily cycle variations that exist, how they can all be boiled down to a few things: time, inducement, and lower time frame confirmation. That trinity we've been speaking about on the channel for more than 1 year. But when you go a level further and you start to realize you can take all of this information, think of it like a funnel, you can actually condense it down even further into trade models, where you take all of the variations that exist, all of the price action models that exist, and you condense it down into a few tradable trade models, a few exact criteria, database checklists that are specific scientific trade models. And you simply come to the markets and say, hey, does this fit any of my trade models? If it does, which one? And if it meets the final criteria to enter, you do enter. If you come to the market and it doesn't fit any of your trade models, you walk away. And in the last video, we broke down in depth exact case study and example with a trade breakdown of a reversal model type. And in this video, what I'm going to show you is the other one, the continuation model that exists. And if you look back in my 1 year track record of the last year of my live call outs to the public, my live trades ahead of time, giving the entry, stop loss, take profit level for more than a year, publicly documenting over 70 trades and 55% gain. What did we learn in all of that time frame? What did we learn in all of those trades? That every single one of those trades follows the trifecta. Every single one of those trades is one of my predetermined trade models. And most importantly, every single one of those public signals was one of the two continuation or reversal models. So in this video, we're going to unwrap the second part, which is how to trade and understand a continuation model, how to identify it, how to execute on it, and then we're going to show you a full case study to show you recent price action, today's price action, on how I entered a continuation model trade. Let's get right into it. So in the last video, I started to break down exactly this, that we have a time, inducement, and lower time frame trinity. This is the foundation. Off all of this, you build trade models. But when we take a closer look, and the certain important things that we have. When it comes to time, we have our London window, New York window. We don't trade 24 hours in a day. We trade just 2 hours in a day. The most optimal moments in the day to trade based on liquidity, volatility, momentum, inducements, all these things. You have your key windows, data-based, probability-based. And when you realize that you have a London window, the models that can exist are going to be variations of a reversal model or variations of a continuation model. And there's multiple types. You have POI-based, non-POI-based, based on inducements, and then the various lower time frame confirmation sets based on the liquidity cycle. So there's a lot of information on this Excali draw, and all of these flow charts do lead into the trinity, to the trade models, to the confluence sets. And most people don't even make trade models. Most people don't even have a system of what is the foundation of a trade model, like the trifecta. And most people don't even understand the daily cycle. If you don't understand the daily cycle, if you can't find the inducement of the day, good luck with market structure alone. Good luck with SMC alone, because the market moves in daily cycle variations. The market moves after the inducement of the day has been found, and the market is going to be pivoting around that inducement of the day. Either you trade up to the inducement of the day, or you trade after the inducement of the day. That's what we mentioned in the last video. The pivoting point in each day of price action is that inducement of the day. And you need to know what it is, how to find it, how to confirm it, and then trade around it. So if the inducement of the day hasn't happened yet, look for a continuation model trading into that inducement. Once the inducement of the day has happened, you trade away from it. You trade a reversal model. The inducement of the day is that inflection point of the day. You have to find it to master these two trade models that exist, a reversal model or a continuation model. And then you layer in all the other stuff, POI, liquidity, time, and all these other things to build out your trade models. But this should be the foundation for every trader, to know where the inducement of the day is, know the daily cycle variations, and then know, should I be looking for a continuation or a reversal? Forget market structure, because that alone is going to be good, but it's also going to misguide you a lot of the times. So first thing you do when you look at the market, you start off at a higher time frame and you find your main push. Here is very easy to define, where we have the last high in the market. Yes, it's a build up inducement high, perfect, with an internal mitigation. Most importantly, it leads to a lower low, breaking the previous lower low. So we have found a valid bearish push in the market because it's inducement based and structure relevant. Once you have found your main push in the market, you have your trading range. You have an external high and an external low. So anything related inside of this zone is simply internal price action. So when we navigate this, yes, we have the last lower high that made the lower low, but it's within the range. So we have a internal structure point, and we realize that all of this is internal structure, internal lower highs, internal lower lows. So when we mark all of these areas out and we start to realize that this was an inducement right here, this was a build up and inducement right here, This was an inducement right here. The sellers are clearly in control because they are doing inducements that are leading to internal structure and within the dealing range and within the trading range. And then what happens next is you have the last low in the market that goes on to make a internal higher high. That internal higher high takes out the previous lower high that made the lower low. So therefore we have a bullish market structure shift. This area doesn't go on to make a lower low. It fails to make a lower low and respects over here. Grabs some of the liquidity, comes to the previous demand area, and now this area fails to make a lower low. So now we could be in a inflection point because we could be having a bullish push out, bullish break of structure. This failed to make a low, so it's a higher low, and we could be going on to make a higher high to come all the way to the extreme supply zone. That is one roadmap. And because we are still within the trading range, the external range that we mentioned, we're still within the tradable range. This is all valid price action because it's just bearish impulse, retracement, and then a new bearish impulse. So this is just a complex pullback. But as we know, there's variations to what a complex pullback can be, where we could have price going to this low, maybe taking this trend line liquidity, sweeping it, and then continuing to make a lower low relative to this, and then still go higher because we haven't broken the external range. So until we break the external range and make a new lower low, we are going to be bouncing around internal price action. So now that we have a structural read, we know where our liquidity pools are, we know where our previous inducements are and liquidity targets are. This is where we start to navigate a lower time frame because this time frame has served its purpose. We know we are internally bullish because this last lower high that made a lower low now had a bullish breakout. So we had a bullish break of structure that led to an internal higher high, and we had an inducement based demand area forming with all of this trend line liquidity to target. Once we have all of this in place, we have an associated demand area, we have an associated supply zone because this is a lower high that made a lower low internally. We broke this internal structure right here. Again, multi-time frame read where we have internal high, internal higher low, internal higher high, internal higher low, internal higher high. Then we have this push down that breaks all of this. This is broken internal structure over here, and we've come to a previous lower low in the market that was acting as a demand. Why is it acting as a demand? Because it made an internal break of structure bullish. I know a lot of things going on, but you just got to follow the multi-time frame read. Watch it a few times so you get the hang of things and you understand exactly what's going on. But from this, we can settle a framework because now we have an external range, yes, from the lower high to the lower low, external range, but we also have an internal range from this point over here, the last lower high, the last higher high internally because we had this bullish push out, and then the low of that range over here. So now we have established a 4-hour internal range, but we have to now go down to a lower time frame. So now that we have come down to M15, we do the same thing. We find main pushes, we find inducements. And what can we see over here? This is the last lower high that made a lower low immediately, and then this area has induced it. We have got a wick out leading to a bearish push. So let's break this down properly. We notice all of this liquidity and then an inducement led to a bearish push. Same again. We had all of this trend line liquidity. This liquidity that was built up had an inducement over here, led to a lower low. So we have our structure points, and then we have this last area of supply, and this area ended up getting induced too. So we had a buildup of liquidity, and therefore we know this last inducement of supply, these areas that led to the bearish push, the decisional point, that decisional point we refine it down to immediately inducing this supply zone, and therefore coming into the territory of the previous supply area. So we have an inducement of supply respecting this decisional that is an inducement, coming into and doing an inducement, and then what does it do after the fact? It takes out the previous higher low that made a higher high and therefore is a bearish impulse. All this bullish price action that was happening, internal bullish price action with higher high, higher low, higher high, higher low, higher high, and then after that inducement, lower low. So we have now strong intent coming together because we have inducement of supply mitigating previous inducement supply whilst doing an inducement and leading to a structural lower low. This is all brilliant stuff. Now when we zoom in further, we start to notice more details and we start to understand that this lower low went on to make a lower high and also a lower low. So structure is still bearish. We investigate further and we see that there is a lot of buildup of liquidity, and we're also getting once again an inducement, strong wick, and that inducement not only is structurally relevant, but it leads to a lower low. So we are seeing great intent of price going from a previous inducement supply because it took all of this liquidity on the left, led to a bearish push, built up more liquidity, induced, hit the previous zone, and then once again melted again and made a new lower low. This one happened to be a Friday NFP trade. Things are not random. Now, as the new week opens, today's price action, literally today, I wanted to show you this continuation model as we follow the blueprint of time, inducement, and lower time frame confirmation. We follow the POI or non-POI based, and we follow London New York. Continuation model is what I want to show you today. We follow all of this framework and we build out a daily cycle for this day. Now, from all we've studied so far, we can see there are certain options. Prices come to a previous higher low that made a higher high. If prices come to a previous higher low that made a higher high, it's a demand area. We could expect a bullish reaction. Maybe so. So we need to be aware, if we do get a bullish reaction, where is it going to go? If price starts to go bullish over here, makes sense. It will go to the last supply zone of inducement. So price is going to follow this chain that we are seeing of inducement, lower low, inducement, lower low, inducement, lower low. Where did these inducements hit? This inducement hit the previous inducement supply. This inducement hit the previous inducement supply. So price now here could come to this previous inducement supply. So that is a supply zone variation that price could go towards. Now, it doesn't have to always go to this extreme supply area. It could also go to this intermediate zone, because this area had the final bearish push where we have internal structure. When we start to read that, we have high, lower, low, lower, high, lower, low, lower, high, lower, low, lower, high, and then last lower low. So we can actually start to look into this area and say, okay, there might be some reactions over here, but ideally off the previous inducement supply. We investigate the local zone as well. And we have another option, which is if price is not going to go up and have a bullish reaction, maybe this demand area only gives a small reaction and then continues bearish. Where could it go towards? Well, it makes a lot of sense to go all the way to this previous demand area somewhere within this region. And why is this valid? Because this demand area led to bullish internal structure, and it also reacted off a previous demand area on the left after taking all of this liquidity, hitting a demand area on the left. So we're layering things once again. We see a stack of demand where we have area number 1 and area number 2, and then we have a stack of supply where we have area number 1, 2, and 3. And we are in between that range. We now follow the trinity of POIs, and then after those POIs we have time, inducement, lower time frame confirmation, and we build our daily cycle variations with a continuation or reversal model. That's all we do. Now we can come into the lowest of time frames, M1, where we spend most of our time to understand exactly what's going on. So first, we are approaching our London Open. We had Frankfurt Open, and what has that done? When I read my Asia range, what is Asia range trying to convince everyone? It's saying everyone needs to get into a buy. 1 touch, 2 touch, 3 touch of a trend line coming off a demand area that we refined already. Just to remind ourselves, this demand area that led to this push out took some liquidity over here. It's a potentially valid zone. With that buildup of liquidity, that inducement leading to this bullish push out, we have arrived to a demand area in Asia. And then what happens after that demand area? 1 touch of a trend line, 2 touch of a trend line. We are getting bullish confirmation, and it's approaching a session open. Frankfurt Open has happened. What does that mean? Buyers are getting in. You pull a Fibonacci and you say, okay, where is it arriving to? We're arriving to the 50 and 61.8 fib. And there's going to be plenty of traders that are going to be considering this area. Other traders are going to see prices come to this supply area. We're starting to hit that supply zone, and they're going to be seeing smart money traders. They're going to be seeing equal highs or resistance level, and then they're going to be seeing that run of liquidity over here, and then they're going to be seeing that internal break of structure over here. There's last higher low that made a higher high, now making a lower low. We have found a bearish break of structure, and therefore this is going to be a very nice smart money trap in my opinion. So when we have liquidity above here, and we have liquidity below this trend line zone, and we have our inducement of the day yet to be found and London Open happening, we are arriving to this trinity, this time window. We're arriving to the London Open, and we need to look for an inducement, POI or non-POI based, and we need to find lower time frame confirmation if we are to find a trade, and we need to understand, are we having a reversal or continuation model? Now, we spoke about in the last video the reversal model, where we have the inducement of the day or a POI or something going on to tell us we could be reversing. Here we have no reason to reverse. We haven't found the inducement of the day because we haven't taken any liquidity. We haven't even taken Asia high liquidity yet. We're not even in the POI yet. We hadn't had a major or medium inducement. There's nothing going on. So we are yet to find the inducement of the day. So if we are before the inducement of the day, we look for continuation trades. If we are after the inducement of the day, we look for reversal trades or continuing away from that inducement. Think of the domino that falls. Once the first domino falls, then the second, third, fourth. You follow that domino. But if the domino hasn't fallen yet, if that inducement of the day hasn't happened yet, you wait for that domino to fall and you wait for price to go towards there. We are continuing on following trend, which is demand area, bullish push out, looking for that inducement of the day, knowing where the liquidity pools may lie. When we take a closer look at the supply zone, we see that there is a buildup of liquidity over here, and then we have an inducement right here. So this supply zone is a valid one. Personally, I don't trade these kind of supply zones because of the proximity to Asia range, but in theory, people would be trading it because it's an inducement-led lower low. Price is arriving to it. It's given an internal break of structure, London Open pending. We have not found the inducement of the day. If you haven't found that inducement of the day, you look for a continuation model, meaning you continue out of the Asia range. In this case, the continuation is where? We have a bullish channel up. We are bullish for now. We could continue out to this supply zone, or maybe even to those previous levels that I spoke about in the beginning, where we are going to that previous inducement zone. We can refine it to this now, or maybe even more left. We go to that previous inducement zone. There are inducement zones to chase. And if we are going to be bullish, we can wait for that bullish price action arriving to those inducements, whether it's POI based, whether it is point of interest based or non-point of interest based. What does that look like? This is a point of interest based one. This is a point of interest based one. This no man's land is non-point of interest based one. Either way, we can't take a reversal yet, so we have to take a continuation. Let's see if anything presents. So what I'm seeing is all of this liquidity that is being built up. All of that liquidity is not a break of structure. It is a liquidity pool. This could be potentially my pre-inducement of the day, minor inducement. And when I see that is forming, I see we have liquidity grab, push out, and then we have this build up, liquidity grab, fails to make a higher high yet. So we haven't got intent. But when I see this now, this final inducement has not only grabbed local liquidity right here, it's also breaching my trend line, which is nice to see. So we have cause, potentially an inducement. Now I need to see the effect. Do we get a break of structure? No. So no trade. Then we see lower. Okay, we're grabbing all of this liquidity now. We're really breaking the trend line and we are really selling that this is a bearish push. So we're inviting traders to sell. And once we see that, what do we see here? Okay, that's interesting. Not only have we avoided this trend line liquidity, we've also avoided any liquidity that was building up here. And we've found a potential pre-inducement of the day, minor inducement in the key time window. And it's following the principles of a continuation model because we are continuing out of the Asia range. We are trading out of the Asia range, following liquidity taken and liquidity engineered above. This is perfect stuff. So now I can start to load up a buy trade based on this zone, stop loss at the low, and looking to trade out of my Asia range. Price taps in, comes to the refined IFC, stop loss at the low. We look to trade out of Asia high. Continuation trades are usually short-lived, so 1 to 3 will be appropriate. And you're looking to target this potential supply zone or maybe even higher to the other supply zones we mentioned. What do we do once we have the M1 shift? We move our stop loss to break even right here, stop loss to break even. That is our standard protocol. So now our stop loss is right here. And then we allow price to breathe and potentially wait for the inducement of the day. So what happens when a price arrives to that smart money zone where smart money traders are seeing build up equal highs, run of liquidity, bearish break of structure, London open, they'll be looking to sell and they will get taken out. Now price comes into the supply zone. Traders are going to be thinking, okay, we got unlucky on that smart money trap, but supply zone price is going to reverse from here. So they'll be looking for potentially sells. Okay, so we fast forward a little bit and we start to see that, okay, this continuation trade that we entered over here meets our 1 to 3. Very sharp. That's a lucky. It doesn't always happen like that. Sometimes we'll smoke through, sometimes it won't even reach. But in this case, we had our break-even protocol, hit the 1 to 3 place we want to take profit, and then it's come to where? It's come to that previous inducement supply zone. I'm not going to be trading this because it doesn't meet my criteria of supply and it's not in the key time window that I want. So this trade is now terminated, but we follow on price action and we see price has now done a build up over here and it's done an inducement over here like so, and it's led to a bearish push. So we have now created a lower high, breaking structure and leading to a potentially lower low, potentially taking this area out. Whereas it hits a previous inducement supply after taking all of that Asia high liquidity, all of that smart money trap liquidity. We've taken a lot of liquidity to the high, smart money trap, Asia high, supply zone, done an inducement, minor inducement over here, and had a bearish switch. So now we've potentially found the inducement of the day. So what do we do now? We look for a reversal model, and that reversal model is going to be reversing away from this inducement of the day and following on from that bearish trend we already found. So now we start to see this is the last bearish push, lower high to lower low. This might be the next lower high. We go on to make a lower low and target all of this remaining liquidity that is resting below here. So now we are in the building works of a reversal model, the next criteria, and we wait for when? We wait for our next key time window. We don't trade anywhere else. Key time windows is the best time to be trading. New York Open is approaching. New York key window is right here. And what do we see? This is a non-POI based scenario because we have now found the inducement of the day with a bearish switch. We need to trade away from that. And this is a non-POI based one because we're approaching the time window. What are we seeing? Minor inducements, equal lows resting below a liquidity target, and therefore a place that you can potentially sell from. We have a tolerable range of 3 to 7 pip stop loss. If we have an entry of 7 pips, the top end of the range, the entry is going to be right now. I'd rather not have that. If we base it on the M1 refined IFC, it's just 2 pips. It's too small. When we look at M5, which is the next thing you would naturally do, is giving that same 2 pip stop loss. The only thing you do here when M1 and M5 is not giving clarity, I just put a safe bet at 4 pip stop loss. I don't want to have a 6 bond. I'm not going to do a 2 pip stop loss. 4 pip stop loss right here. Equal lows to target, session open, imminent, and 2 minor inducements, non-POI based. And most importantly, we are trading away from the inducement of the day established. So we do a continuation trade to buy up to the inducement of the day. Once we've had the inducement of the day, we trade away from that as reversal models. And this is an example of just that. You tap in and then it goes, you break even on the M1 shift. Your 1 to 3 is your first partial point, like so. That way alone, this could be a 3% if you're taking a continuation full volume. And then here you'll take a partial at 1 to 3. So 3% plus 1.5%. There you have already a 4.5% day just by understanding continuation and reversal. And by the way, this is not a cherry-picked example. This is literally today's price action, the day that I'm filming it. If I come out of replay mode now, you will see this trade is still in motion. And when did it happen? This might go on to the full 1 to 10. Why could it go on to the full 1 to 10? Because when I jump out on another time frame, we know that we are in a supply zone, lower low, supply zone, lower low, supply zone, inducement, lower low. Where are we targeting? That external liquidity we mentioned, that external range. And where is that internal range from here to here? And where is that external range all the way down here? So from a structure perspective, the next place it could go is go on to make a lower low like so. I'm not going to be holding the trade that long anyway, but this is an example of exactly how you trade price action based on inducements of the day, minor inducements, the trinity of time window, lower time frame confirmation, and inducements. And did that happen here? Yes, we had our key time window of London, the gray box. We had an inducement and then we had a break of structure to trade it. Trinity met, continuation model met. But then we had our New York window, time window. We had a lower time frame confirmation, yes, and we had minor inducements to confirm it. Trading away from the inducement of the day, reversal model. This is a picture perfect scenario of continuation and reversal models, the things we've been explaining on the channel for more than a year. And you don't need market structure, you don't need supply and demand, you don't need SMC indicators, all of that stuff. All you need is a trinity, which we've been explaining for a long time now. You need trade models, and then you need to know where you are in relationship to the daily cycle. Have you found the inducement of the day? If you haven't, continuation model. Once you found it, reversal model. And more importantly, when you combine all these things together, you just need to be restricted to follow your plan. Because as you know, a restricted trader is a profitable trader.